Hi, I'm John Fitzgerald and welcome to this week's edition of Team Wealth Builders. I want to give a bit of an economic update because there's so many things happening, and the talk at the end of 2012 was this economic cliff that America was supposed to go over and everyone was panicked about. You know, it's amazing how everyone loves the fear and the danger of everything, and when it gets to the crunch, nothing ever actually happens. And that's so true in so many circumstances. And sure enough, there was no economic cliff. America has really solved their problem. But more important than that, there's a couple of things that come out of America. They're printing more money, they're devaluing their dollar, and that's going to cause Australia to devalue our dollar, which is going to bring interest rate down. I want to talk about that in a minute because one of the biggest things we have to focus on now is fixed or variable interest rates and what's actually happening with that. But let me get back to America. They're clear in saying one thing. We want to bring unemployment down to 6%. It's currently trending towards 8% in America, and we're going to do whatever it takes until it comes down to 6%. Their biggest tool is to get agriculture and manufacturing going, and that's what's actually creating jobs. And they're doing that because they're bringing the value of their dollar down. Now, that's having worldwide ramifications because now the euro's being devalued, and now Japan's weighed in as well, bringing in a stimulus, and they're devaluing their dollar, and Australia's now just propped up there to a point where one of our Reserve Bank governors said our dollar is worryingly high. Now, this is how it plays into interest rates in so many ways. Very, very interesting. And I think very interesting from a timely perspective because our second biggest export today is actually government bonds. And they're at were at 3.25%. They're now at 3%. But those bonds are one of the highest stable bonds in the world. So there's lots of money coming into the country. Russia, various other countries buying Australian government bonds at 3%. And the forecast by the main four banks is that that will drop to 2.5%, maybe even 2%. And one of the pressures is that we've got to get the value of the Australian dollar down to support our own manufacturing and to assist in our own tourism, which are big money earners for us, particularly given the flag that's already come up that mining's going to reach its peak. Now, the mining boom's not over. The construction phase of the mining boom is just going to reach its peak. Now we get into the production of the mining boom. And this will be an interesting phase, or phase 2 of the mining boom. So don't worry about that. And mining's not such a big deal because it only employs 2% or thereabouts of the Australian population. The real big factors that we need to get moving, that are moving, are your manufacturing, are your retail, are your healthcare, are your property and construction. And that's where it really plays into us. It plays into us because they've said, okay, and this is the Reserve Bank and the government, we now know mining's going to reach a peak. We have to now support property and construction. And down are going to come interest rates. I look at the swap rate. The swap rate is the interbank lending rate. That is what banks lend to each other on an unsecured basis. The 90, 120 days, it's still going down. So whilst it's still going down, while it's still below the variable, I'm still comfortable sitting and not having to lock in. But I do have in the back of my mind, and what I'm saying to you is, I think you should be conscious of potentially locking in your rates by June this year. I'm not saying rates will go up past June this year. I'm just saying that's when we could get the best deal. And when you see the swap rates, the 180-day swap rate, particularly in the longer-term swap rate, start to go up, that's when your variable rates will turn the corner. You can lock in rates now sub 5.5%. And let me tell you, in 30 years of being in property, I've only ever seen that once before. And that once before only lasted for 4 months. So this isn't something that's going to last. You need to be on top of that. You also need to be aware that sales are taking place. Lots of sales and prices are increasing. So it's now already the start of 2013, we've had price growth. RP data reported growth in December and now growth in January. And local developers, let me tell you an inside story, local developers in Brisbane have been putting their prices up by 5 to 7% and selling. So there is real activity in the market today. I said it's the start of the boom in 2013. Interest rates are a big factor on that. overseas money coming in because Australia is such a stable economy. But you look around the world at what's happening in America, Japan's fiscal policy and their stimulus package that they're bringing on. Europe, the fact that you can borrow money in Europe sub 1%, we become a very attractive safe haven. You're going to see lots of money coming into Australia, and they're the impetus for this massive boom that's going to happen. So make no mistake, it has started. In a real estate perspective, we're seeing a mopping up of all the remnant stock that various other developers have been caught or mortgaging possessions, etc., but that's going very quickly. And just look around your own neighbourhoods. You'll see lots more sold signs. It really is happening. A really exciting time. The real takeaway, though, is fixed or variable. You really need to be looking at consciously each month what the best fixed deal you can do. Thanks for listening to me.